We've talked about the budget being an aggregate demand management policy in recent videos, but now we're going to consider the budget as an aggregate supply management policy. So we're going to look at how the budget, or inbuilt components of the budget, can help improve our aggregate supply side conditions. So as we know, aggregate supply is a component of primary factors and also a component of secondary factors. Now, primary factors include labor, land, and capital, also denoted K. So we have L, L, and K. Secondary factors of production include productivity. Although it is very easy to measure land, labor, and capital resources, productivity is very hard to measure. And economists measure productivity by using the residual effect. And we won't go into depth about how they measure productivity, but we're just going to note that there are primary factors of production and secondary factors of production. So in this video we're going to look at how reducing pay-as-you-go tax rates can help improve aggregate supply side conditions. And we're going to focus on how it can improve labor resources and how it can also improve productivity. So we've noted that reducing pay-as-you-go tax rates is a component of the budget. It is also known as a discretionary stabilizer. Once the government actually reduces tax rates a further year, it actually becomes an inbuilt component. So after the government announces a reduction in the tax rates, that then becomes an automatic stabilizer. So for the first year before it is introduced, it is known as a discretionary stabilizer, but for ongoing years, for every year coming forward, it is known as an automatic stabilizer. So how does reducing pay-as-you-go tax rates increase aggregate supply side conditions? So what many economists argue is that with lower income tax rates, this would increase personal effort. So what this causes is that it increases personal effort. So to look at a working example of this, say a person earns $100,000 per year, per annum. If we average this out, they pay around 35% in tax. So they have to pay $35,000 or thereabouts in tax. So the disposable income left after taxation is only $65,000. If, however, the boss says, okay, if you work an extra 10 hours every week, I'll increase your income to $120,000. And if you average this out, for example, then because they're moving up an income tax bracket, then therefore the proportion of income they have to pay may be around 37%. Well, let's say, for example, that 37% of $120,000, you can calculate that using the calculator. So 0.37 multiplied by $120,000, and you get around $44,400 in tax. So that leaves us with only $75,600 worth of disposable income that we can spend on consumption. So as we can see, although we're putting in that much more effort, we're not actually increasing our disposable income by that much. We should increase it by $20,000, but in fact after tax we're only increasing by $10,000. And so is it worth the effort of putting in, say, 10 hours extra a week, foregoing leisure time, and foregoing any other benefits you would have experienced from not working? Is it worth it that so you earn only $10,000 more, around $10,000? And so this is an example of a cost-benefit analysis. Some people will say, okay, it is worth it because I have nothing better to do with my time. But most people will say, okay, it's not really worth it to only earn $10,600 more and foregoing 10 hours a week of extra leisure time. I'd rather spend that time with the family, or going to the football, or going to concerts, having leisure time, doing stuff that I actually do enjoy. So with a decrease in personal tax rates, that would actually encourage people to work more, because with a decrease in tax rates, this perhaps averages out to be not 35%, but in fact, say 30%. So let's look at two different scenarios. This averages out to around 30% of your income paid a tax. 30%. That means you have $30,000 paid a tax and $70,000 in income, or disposable income. If you earn $120,000 more, say they've actually increased this tax bracket threshold, and you're only paying 31% in tax. So 120,000 multiplied by 0.31, that would equal 37,200. So what this means is that your income is actually higher. So your disposable income is actually higher in this case. So instead of having only 70 and a bit thousand before, 75,000, you're earning an extra, say, $7,500. And that could be the difference between people putting in more personal effort and people not putting in extra effort. And as we know, since labour is a component of aggregate supply, by decreasing tax rates in this way, that would actually improve our aggregate supply conditions. The second argument is that it keeps skilled workers, or skilled workers rather, those white collar workers. So the argument goes here is that by reducing tax rate, it keeps those skilled workers within our borders. So many skilled workers who earn very large amounts of money, they would actually seek to be based overseas. So take for example someone like Leighton Hewitt. He's actually based in the Bahamas because in the Bahamas he avoids tax. And same with people who are based in Dubai or in the Caribbean. Those countries, they all don't pay any income tax, and therefore those people who are actually skilled, who actually earn a large amount of money, they don't have to pay income tax, and therefore they have more incentive to go abroad. So by lowering these tax rates, that actually encourages these people to actually stay in Australia. And because at the moment we have what is known as a skills shortage, this can increase our productivity. So we want to keep these white-collar workers within our borders because they add to productivity and henceforth add to aggregate supply. So by lowering or reducing pay-as-you-go tax rates, it not only stimulates the individual participation in the labour force, but also encourages those who are skilled to actually stay within domestic borders. And that would increase our aggregate supply by increasing our potential labour force and also increasing our productivity. So the theory goes, by reducing pay-as-you-go tax rates, that incentivizes people to increase personal effort and to also increase the amount of people working for Australia.